All right, traders, it's a very busy central bank week this week. We've got the FOMC coming up, the Bank of England coming up, the Bank of Japan coming up. And as always, the Fed will get the most attention this week. This week's meeting also accompanies the Fed's summary of economic projections, which includes the very infamous dot plot that'll show us where the Fed thinks rates will go this year. Now, this meeting comes at a very interesting time for the US dollar, as well as the US economy, because recently the dollar has been in a bit of a free fall as US growth concerns have really started to gain some momentum. The big drop we had in forward-looking GDP measures like the Atlanta Fed GDP, now the continued fall we've had to the downside in business as well as consumer sentiment, as well as the big drop we had in manufacturing PMIs, has all caused the markets to worry about US growth. And of course, as a result of that, we've seen assets like the US dollar, as well as US equities, as well as US yields for that matter, all see quite a lot of downside as markets have started to price in a possible slowdown in the US economy. Now, the big question for this week's FOMC meeting then is how the Fed will see the broader economy and whether what markets have been worried about will be enough to see the Fed potentially change their rate projections. Now, at their December meeting, the Fed projected 2 rate cuts for 2025. So the question is whether they stick to this view of just 2 cuts or whether the recent data has been enough for them to potentially see scope for more than 2 cuts this year. Now, as always, there's a few caveats in that mix because even though things like CPI, which remains a continued worrying factor for the Fed, even though we saw CPI coming in lower than what the markets had anticipated last week, both headline as well as core CPI remains well above the Fed's 2% target. Furthermore, we also saw yet another big jump in consumer-related inflation expectations on Friday for both the 1-year as well as the 5-year measure, with that 5-year measure actually hitting its highest level in over 3 decades. So that is definitely something that the Fed will be taking into consideration as well. And it also seems that markets have largely ignored the still very solid ISM services PMI from 2 weeks ago. Even though manufacturing obviously saw a bit of a slowdown, services makes up close to 80% of the US economy. So this is one area where the Fed could potentially be seen sticking to their guns of just looking for 2 cuts this year. Now, where all of this gets really interesting for this week's FOMC is because short-term interest rate futures, as we can see here, have already priced in very close to 3 cuts for the Fed this year. So this means if the Fed, for the sake of caution, should decide to show 3 cuts instead of just 2 cuts for this year, that should not really surprise the markets because rates markets have already reflected that, right? So we wouldn't really expect that to have a big impact in things like the S&P or the US dollar. But because the markets have already priced in close to 3 cuts for the Fed for this year, if the Fed should decide to leave their dot projection and only show still 2 cuts for this year, that could provide the dollar with a bit of a relief rally in the short term. Especially so if the Fed doesn't, sound as negative about the economy as some of those forward-looking measures have suggested. And also, when we consider the amount of downside that we've seen in the dollar in a very short space of time in recent sessions, as well as the fact that positioning data has now shown the dollar moving back into stretch short territory in a very short space of time, that means that if the dot plot should only or still show 2 cuts for this year, that could provide a decent bounce opportunity for the dollar. Now, key levels of resistance to watch to the upside in the event of a decent bounce. The first one comes up around that 104.50 psychological level, which is also the highest going back to October last year. Above that, we've got the 1-week implied volatility high resistance level coming up around that 105 psychological level. And above that, we've got the 105.40, which also coincides with that swing low going back to December. It's going to be a very interesting FOMC. So as always, stay nimble and trade safe.